Hello. My name is Jason Allen. I'm a realtor in Palm Springs, California. In light of the recent banking volatility, I figured here it is, March 16th. We've had about a week of this. I'm going to just speak to it with respect to the housing market. Some are trying to make the comparison between what happened with Silicon Valley Bank and the implosion of it to what happened when Lehman Brothers fell in September of 2008. Not the same. Fundamentally, we can say that Silicon Valley Bank had a good old-fashioned bank run. For those that don't know or don't remember, banks take in deposits and then they loan that out. In this particular case, Silicon Valley Bank had lots of deposits, and they took that money and they took a large percentage of it and they invested it in the bond market with the expectation that the Feds would not raise rates, short-term interest rates between banks, which is what everyone talks about when they say the Fed interest rate. Problem is that created a liquidity issue for them because that money was locked up at a low rate when they could have been making more on it, but they had no way to pull it out of that investment. People who had deposits in the bank started to get nervous, and then some started to withdraw their money. And, no bank typically has enough money in the bank to satisfy all deposits. They need to invest that. That's how they get their returns. That's how they make money. That's their product, is lending money. And the Fed stepped in. Fed stepped in by taking over that bank and another bank. They said, we're going to honor all deposits using the FDIC insurance bank or insurance money to cover all losses. Investors, however, who invested in the bank, you lose. Okay. Very, very different from what was happening in 2008, 2009. In that case, you had banks overextending themselves, loaning money to unqualified individuals. And when those individuals couldn't pay their money back to the bank and started foreclosing, it created a wave problem, a whole bunch of toxic assets that had been bundled and sold to investors without investors understanding the underlying problems in that asset. In the case of Silicon Valley Bank, I'm not talking about that. We're simply talking about too many people wanted their money out of the bank all at once. We are not going to see housing prices cascade into free fall. Here's why. And I've said this over and over and over again to my clients or anyone that'll listen to it. We've had 10 years of people having to have a real job, have real credit, and have real money to put down on that home purchase, typically 20%. Those people who purchased in the last couple of years bought at super low interest rates. And they can afford their loans unless they lose their job. But that would be an economy issue. But the last time I looked, our economy is going gangbusters. We have super low unemployment. That means anybody who is in a mortgage and loses their job is very likely to be able to go find a new job. So they're going to keep paying their mortgage. Nobody wants to lose their down payment. And then we've had another year and a half or overlaying the last 2 years with a lot of people paying cash for their property. That's certainly true in our market. I would say if I reflect on the deals last year without doing an accurate accounting, half of those were with cash. And the other half were very well qualified individuals financing. So what we're really seeing in the marketplace, as I did in my Monday market moment, I showed that about 30% of our homes are still going into contract over asking. We are not going to see a housing collapse. And in fact, if I quickly show you something here, you will understand one of the reasons I feel so confident of that. Mortgage applications went up. And in fact, if you look at these two lines, There's the orange line, there's the gray line. You can go to this website, not a big deal. You see the inverse effect of these. You see as interest rates go down, mortgage applications go up. If you are thinking about buying a house, you have the opportunity to negotiate on your purchase. If you wait till these rates come way down, you're going to see applications go way up and you're going to be in competition for the house you want, house or condo you want. What you're better off doing is potentially negotiating a temporary 2-1 buy down when you are trying to purchase your home. That would give you 1 to 2 years of lower interest rates. And then when interest rates ultimately fall, and they are expected to fall some, you can refinance your home and lock in a 5.5, even maybe even a 6% rate. We're currently at 6.9, but 6.69 is actually a good rate. The key is you're not in as much heated competition. 2/3 of the homes sold in our market are not in heated competition. This is a moment to take advantage of what's happening in the marketplace. If you have any questions about this or anything related to real estate, I am happy to have a one-on-one conversation with you. Call me, 760-325-1900. That is my cell phone. Have a great day, and I will respond to any comments below.